Hello, and welcome to this video, Understanding Binary Options. It's part 2 of a series of videos, and this particular video deals with binary option trading from the perspective of someone who has a little bit of experience and is employing a basic strategy, as opposed to part 1 of the series, which dealt with binary option trading from the perspective of a novice, someone who had little or no expertise in this area. So just to give a quick review of binary option trading, essentially we pick a commodity or a currency or any stock index. Each of these has a current value right now at any given point in time, and binary option trading relies on our ability to predict what the future value is going to be at some time in the future, and we call if we think that the value will go up, and we put if we think that the value is going to go down, and being right gets us a percentage of the profit, but being wrong means we lose all of what we invested. And for those of us who are interested in detailed analysis of binary options, I think part 1 of this video series would be the best place to start, and I'll provide a link in there for the video. But moving right on, while part 1 dealt with binary option trading from the perspective of someone who has no expertise, in this particular video we're going to talk about employing a very basic strategy. While part 1 talked about treating each trade independently of the other, in this case we don't share that perspective. Essentially, if we make a bad trade, we use this information to sort of make the next trade smarter, to make it better. The principle behind this is that no stock or index can rise or fall indefinitely. So whichever direction we pick, whether we want to put or whether we call, if we stick with it, eventually we should be correct, because there is a ceiling with respect to how fast or how great an index or stock can grow, and of course there is a limit to how low it can fall, and that limit's actually 0. Now the idea here is that when we're correct, we try and offset any losses that we make when we're wrong. Therefore, let's say we make several trades, and each time we get it wrong, as long as when we get it right, we're able to counterbalance the losses that we make, we'll be all right. And that's the basic principle behind this strategy. So let's look at a quick example. Let's say it's 9:30 right now, and the euro to the US dollar is currently at 1.4. Now we think it's going to be higher in 30 minutes. That's at 10 o'clock, so we call. But at 10 o'clock the value is actually 1.2, and we were wrong. We made a loss. Now what if we called again at this new value, 1.2? So now in 30 minutes, that is to say at 10:30, we think the value is going to be higher than 1.2. If we're wrong, now the value fell again and it's now 1.1, what if we called yet again? Now the idea here is that the value can't keep falling forever. 0 is the limit, and I mean, under all practical considerations, there's no reason why the euro to the US dollar should ever hit 0. Therefore, we can keep calling, and eventually we'll be able to get it right. And each subsequent trade we make, we increase the amount invested so that when we win, we make up for our prior losses. Let's take a look at what this will look like. So arbitrarily, without loss of generality, let's just assume we call, with the understanding that the example works just as well if we talk about putting, and let's assume the rate of return for our trade is 80%. Now let's say we made a trade with the euro to the US dollar, and the current value is 1.4. We invested $5. Now if we got it right, that's the column on the very right hand side, our profit would be our investment, $5, times the rate of return, 0.8, which is $4. But if we're wrong, and that's the column to the last, the fourth column from the left, and the second last column from the right, if we're wrong, we lost all of our investment, and therefore we lost $5. Now, if we lost $5, we want to go ahead and continue, so we make another trade. Bear in mind, if the value at this given time is less than 1.4, let's assume it's 1.2 now. So we make this second trade, the current value being 1.2, and we decide that the future value is going to be greater than 1.2. So this time we invest $10. Notice that the amount we invested this time is greater than the initial amount we invested, $5, and we'll get to that in just a minute. Now, on this particular trade, trade number 2, if we get it right, the profit would be 10 times 80%, which is $8. Now, earlier, our first trade, we lost $5. This time, we made $8. Our real profit here is 8 minus 5, $3. Therefore, by virtue of being right the second time, we took into account the loss we made during the first trade. Now, supposing the second trade had gone south as well, our total loss in this case is $15. $10 from this particular loss and $5 from the first loss. Now let's say we got it wrong again, and so we make another trade. Now this time the current value is 1.1 and we still think that the value is going to go higher. So we continue to call, except this time we invest $20. Now if we're right, our profit is 20 times 8.8, which is $16. And again, $16 is greater than our total loss at this point of time, $15. Therefore, we still make a profit of $1. But if we're wrong on this third trade, we end up losing 20 plus 10 plus $5. That's a total of $35. That's how much we need to offset if we're going to make money in the future just to take care of this loss. So let's assume we got it wrong yet again on trade 3, and therefore we make a fourth trade. Now the current value is 1, and we really believe that the future value is going to go up, and this time we invest $50. Now if we get it right, then our profit is 50 times 80%, which is $40. And notice that 40 is greater than 35. So overall, after 4 trades, we end up with a profit of $5. But if we get this fourth trade wrong yet again, this time our total loss is $85. $50 for this trade plus the $35 with earlier accumulated. And for the sake of example, let's conclude on a happy note. Let's say we make a fifth trade. Now this time, as it turns out, the value is greater than 1.0. We got it right. Our investment here is $120, and our profit would be $120 times 80%, which is $96. And therefore, our total profit will be $96 minus the loss thus far, 96 minus 85, which puts us at $11. That's the profit we would have made after 5 trades. The first 4 of which we got wrong, but the fifth one we got correct. And this is a good example of the strategy, this basic strategy that people like to employ, where they try and use bad trades or bad bets made early on to subsequently make one good trade, each time increasing the amount that they invest in order to offset any losses that they make early on. So this, of course, brings us to an important question. Just how much should we invest in each subsequent trade in order to offset the previous losses? Now, for those of us who aren't clear about this, the answer to this really depends on the rate of return. And the equation to use here is that the amount that we need to invest each subsequent trade has to be greater than or equal to the rate of return times the loss thus far. So if we go into, if we look at the second trade, why did we pick $10? It's because 10 times 80%, $8, is greater than $5. If we had picked something like $6, 6 times 80% is actually $4.80. Now, even if we had got the second trade right, we would have profited on the second trade with $4.80, but we had a loss from our first trade of $5, which means we would have still ended up losing 20 cents. That's $5 minus $4.80. Therefore, that's why we needed to pick an amount, something like $10. It could have been slightly smaller, but it couldn't have been something like $6. Now, just to take another example, in the fourth trade, why did we have to go with a number like 50? What if we had picked a number like 40? Well, let's see. Prior to that, our cumulative loss had been $35 from the first 3 trades. Supposing we had put $40 on the fourth trade, our profit would have been $40 times 80%, which would put us at $32. Now, $32 is actually less than $35, which means even getting it right on the fourth trade would have still resulted in an overall loss of 35 minus 32, $3. That's why we needed to put an amount like 50. Therefore, it's important to remember, if for each subsequent trade, if we're wondering what's the correct amount to invest, we need to go with the formula given in the yellow rectangle over there. So overall, there are several things we need to be careful about with this strategy. It's kind of like a game where we're trying to outlast a certain trend. In this case, we're making a set of bad decisions with the understanding that eventually we're going to get it right. But it's important to take note that we need to have enough cash in order to keep upping the amount invested until we can get it right and offset the losses. There's no point starting out with $200 and then running out of $200 only to think, oh my God, if I had just made one more trade, I would have been able to get all of the losses taken care of. That's no good. So we need to have a substantial cash base. And even then, with this strategy, there's still no guarantees. It's important to understand that things can still go wrong. And it's very important to note here, timing does matter. For example, let's say it's 10 o'clock now, and we think the value at 10 is going to go up. We may be right. The value is going to go up, and therefore we put a call in at 10:30. But what if the value ends up going up at 10:15 or 10:26, and then it falls down again, and it just happens to be down when it's 10:30? In this case, we were right, but we were not right at the right time, and we would have still resulted in a loss. So overall, this strategy is not free of flaw. It is, in the end, a very basic strategy, but it's definitely better than going ahead with the novice view, which is absolutely 50-50 scenario. And again, you can refer to part 1 of the video for that. So the general verdict would be, please still be careful with this kind of strategy. This video does highlight the strategy, but we still need to go with the idea that this strategy cannot be employed without exercising a lot of caution. And that concludes this part 2 of this series, Understanding Binary Options. In this video, we looked at a very basic strategy, and we talked about sort of how we can offset losses made in earlier trades by subsequently making good trades. But of course, we've opened the door to ask questions such as, what's the right amount to invest, and how do you really know if you'll ever be able to outlast a certain trend, and how do you really know when trends are going to change? And we'll talk a little bit about that in subsequent videos, so maybe a part 3 of this video series. But that's it for now. Happy trading, and if you're going to go with binary options again, please be very careful. Thank you.